Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today. Good morning. It's Monday, November 17th. London Open Prep. Three themes stand out. The US dollar firmed as traders dial back expectations for another Federal Reserve rate cut. Oil eased as a key Russian export hub came back online. And tech sentiment found a lift from Samsung's sharp memory price hikes and a new Berkshire stake in Alphabet. Starting with macro and policy, the dollar is on the front foot, with the U.S. dollar index extending gains as markets fade the odds of a December cut. That tone is pressuring major pairs, with euro-dollar slipping and dollar-franc holding gains, while gold is lower for a third straight day. The Dana backdrop is unusual after the shutdown, but we'll finally get the delayed U.S. jobs report for September this week, a piece that could help rebuild the picture. In Europe, one policymaker warned that a run on stablecoins could force the European Central Bank to adjust policy, and separate comments flagged the risk of inflation undershooting, even as equity market risks were noted. In Asia, Japan remains in focus. The yen is soft near recent lows as weak third-quarter growth keeps pressure on the central bank to hold off on tightening, though industrial production beat expectations and a sizable stimulus is being prepared. Bond markets continue to reprice, with Japanese yields moving up, a shift that matters for global liquidity after years of ultra-easy policy. Geopolitically, tensions with China ticked higher around contested waters, and Tokyo is sending an envoy to Beijing to steady the relationship. Turning to markets and corporates, Samsung lifted contract prices for key memory chips by as much as 60% compared with September amid an AI-led shortage, reinforcing tight supply and boosting chip makers. From U.S. filings, Berkshire Hathaway disclosed a multi-billion stake in Alphabet, helping lift U.S. equity futures in early trade. Meanwhile, Bitcoin sold off sharply, at one point giving back its year-to-date gains and briefly turning negative for the year. On commodities, oil is softer after crude loadings resumed at Russia's Novorossiysk port, unwinding some of last week's disruption-driven gains. Precious metals are split, with gold slipping on the stronger dollar, while silver catches a bid amid lingering uncertainty after the end of the shutdown. In currencies and sectors, the firmer dollar is weighing on the euro, the Australian dollar, and the yen. Euro Canadian is softer ahead of today's Canadian inflation report, and dollar Canadian is finding support from weaker oil. Dollar rupee is contained as India's growth outlook offsets some of the greenback's strength. And Aussie yen holds a bullish tone as solid Australian jobs data keep the central bank cautious rather than dovish. Looking ahead, the calendar picks up. Watch Canada's inflation today, then the delayed U.S. non-farm payrolls for September later this week. We also have minutes from the Federal Reserve and the Reserve Bank of Australia, inflation prints in the UK, Canada, and Japan, and a high-profile U.S. tech earnings release. What I'll be watching today: euro against the dollar, the bias remains lower, while U.S. rates expectations lean less dovish. Dollar against the yen, an uptrend if Japanese yields keep rising, but the central bank stays patient. Dollar against the Canadian dollar, a gentle uptrend if oil stays soft and if Canadian inflation doesn't surprise higher. I'm also watching Euro Canadian into that CPI print, Aussie yen for signs that carry appetite persists, gold for further dollar-driven pressure, and oil to see if the pullback holds now that Black Sea flows have resumed. The takeaway: the dollar is firm and the policy impulse is gently shifting. Tech is finding selective support, and markets are constructive, but still sensitive to data and liquidity signals. That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.